This is ETF.com's weekly video series, Talk ETFs. My name is Sumit Roy, and I'm Senior Analyst for ETF.com. This week, I'm talking with Jake Hanley, who is the Managing Director and Senior Portfolio Manager at Teucrium, an agriculture-focused ETF issuer. Jake, welcome to the show.
Thanks for having me.
What is the long-term case for investing in agriculture? What's the bull case and what's the bear case?
Well, there's a cycle in agriculture that we call the golden grain cycle, and it occurs in 3 stages. And you can see this throughout time when you look at charts of corn, wheat, soybeans primarily. The first stage is prices tend to trade at or near the cost of production. And the reason is that farming is subsidized across the globe. Farmers are paid to plant. In the United States, we have subsidized insurance programs so that farmers, plant without worry of a drought, impacting their crops. And the reason is no country wants their people to go hungry. And so farmers will make a profit, but it's pretty marginal with crops trading at or near the cost of production until there's a supply disruption. And usually that supply disruption is weather. In those periods, we see prices historically have jumped higher. In the case of corn, for example, doubling, from $3.50 as a base to over $7 a bushel. And that's stage 2. Stage 3, when prices get high, farmers across the globe plant as much as possible and rebuild supplies, and prices should come back down to trade near the cost of production again. And so you kind of have those times where you're trading in the valley, you have these big spikes, and then you head back down to trade in the valley. And we are in stage 3 right now. We've been writing about that, where we expect prices to come back to trade near the cost of production. And that is our base case. However, weather, we are in an El Nino cycle now. That's going to disrupt some grain production in key places like India, for example, impacting their rice production. And of course, we do have the war going on. And so there is always that availability concern. But long term, we don't see any reason to expect that the golden grain cycle won't continue in perpetuity. And for asset allocators, that offers an opportunity from the diversification potential, right? Commodities in general, and certainly agriculture, can be that asset class that zigs when other segments zag, okay, give you that diversification. But also when you're paying attention to that cycle, it offers times to be more tactical with your agriculture exposure.
So that's interesting. You talked about this cycle. Right now, we're in phase 3, heading lower probably. So what does that mean in terms of portfolio allocation? Should people have a long-term position in agriculture and then trade around that based on what phase we're in? What should investors be doing?
Based on the feedback we've gotten from financial advisors, there are many different approaches. And one such approach is exactly what you're talking about. Folks that have a long-term allocation to commodities, long only, and then they use agriculture as part of that diversified sleeve and maintain that strategic long-term position. Some of the feedback we've gotten is, Teucrium, Jake, thank you. You're very upfront and honest. We're in stage 3. We don't necessarily want to be holding when these markets are going down. Could you please provide us with a long-short strategy? And as such, we have launched a long-short agriculture strategy. And that's getting a lot of attention because that cycle exists and commodities are volatile. Okay. And so we know that it doesn't always make sense to be long only in this space. And so our hopes is that this strategy can help provide alpha both on the long and short side of the market.
Futures are, of course, one way to play agriculture, but there are, of course, equities tied to agriculture as well. Can you talk about the pros and cons of the 2 approaches?
So when you're talking about commodities in general, again, in agriculture in specific, the futures markets tend to lead the single stock names. So for example, as corn prices, soybean prices rally in the United States, that's typically really good for John Deere because that means farmers are going to have increased profit margins potentially, right? And therefore either fix or buy new tractors. And so I think what you often see is that commodity prices will, if they're going up higher, if they're leading to the upside, that's an indication that you might consider investing in some of the underlying individual companies that support those specific segments. Versus the other way around. Sometimes people try to buy the companies first, expecting the company to do well. Remember that, especially in agriculture, the farmers need to be profitable to be able to go out and buy new farm equipment. And so look for the futures to lead. But that also means if you miss the big upside potentially in these big moves into single commodities, there might be a way to potentially benefit from owning something like a John Deere and so forth. And not stock advice. I'm not recommending John Deere, and certainly got to point that out. But that's something that we've heard from financial advisors as well.
Fantastic. Well, a ton of great information, Jake. Thanks so much for your time.
Yeah, thank you.